Hello everyone, welcome to a brand new trading lesson video on sentimental analysis, how to gauge risk sentiment. There are three ways of analyzing currency pairs, but sentimental analysis hasn't been given the popularity it deserves. It is kind of a complicated way of analysis and it is kind of very structural. So you need to pay attention to the details in this video to understand sentimental analysis very well. Also, I've left a link in the description below that will direct you to a long version blog post of sentimental analysis with an in-depth explanation. Let us dive right into this video, which is meant to simplify the concept of sentimental analysis to you. So with our pointers for today, we have the variation of analysis. This one basically talks about the three kinds of analysis that we can attach to currency pairs. How to gauge risk sentiment. We talk about three ways of gauging risk sentiment, but then our focus will be on the risk on and risk off moods of gauging risk sentiment. Then we finally talk about how risk on, risk off affect currency pairs. Since we are forex traders, so our main focus will be on currencies. So with the variation of analysis, generally we have technical analysis, fundamental analysis, and sentimental analysis, which would be our focus for today. We know that fundamental analysis goes in depth into price action and indicator based strategies. Fundamental analysis also deals with the nitty gritties of economics and how they affect the countries, the GDPs, and all those stuff. Then to what we have for today, which is sentimental analysis. When we talk about sentimental analysis, we are basically asking how do we gauge risk sentiment. There are three ways I explain in this video, but as usual, our focus will be on the risk on, risk off way of gauging sentiment. So the first way of gauging risk sentiment is through the Commitment of Traders report. This is a report that is released every Friday by the CFTC on their website. It shows the number of positions on market instruments, that is the worldwide number of positions that traders have taken in various market instruments. Then the second way is by looking at the positions held by the clients of brokers. It's actually a simplified way of gauging risk sentiment, and it is not advisable to use this way to gauge risk sentiment, and I'll tell you why soon. So using this as an example, if 36% of traders are short Euro USD and 64% of traders are long Euro USD, it will be very prudent to go long Euro USD. Taking a second example from USD CHF, if 57% of traders are short USD CHF and 43% of traders are long USD CHF, it would also be prudent to sell USD CHF. This way is not a good way to gauge risk sentiment because the forex market is a decentralized one. So if you are taking a feed from your broker, that is the position held by your broker's client, you are actually only looking at clients from the particular broker and not the worldwide feed of all forex traders. The Commitment of Traders report is actually the one that gives you a worldwide feed. Then our topic for today, risk on and risk off. So what do we mean by risk on and risk off? The first thing we need to know about risk on and risk off are the trading instruments that are termed as risky and those that are not. So we have stocks are risky and bonds are safe investments. In conventional trading knowledge, stocks are classified as risky assets, whilst bonds are known to be safe investments. The reason why stocks are risky is known in the next paragraph. Stocks can generate massive returns within a relatively shorter time as compared to bonds. Investors always assess the health of the global economy to decide which assets to invest in. So basically, stocks are volatile. That is why they are termed as risky. Stocks rise in risk on moods and bonds rise in risk off mood. Stocks are actually negatively related to the currencies they affect, and bonds are positively correlated with the currencies they affect. But then we wouldn't go into details of the positive and negative correlation of stocks and bonds with currencies in this video, since it is in the blog post in the description area. How do risk on and risk off affect currencies? We need to first know about the risky currencies and the not risky currencies. So the risk on currencies are euro, GBP, AUD, NZD, and CAD. Also, the risk of currencies are JPY, CHF, and USD. USD actually, as a safe haven, presents a really dicey situation. Gold is a wild card because although it is a commodity, it is termed as a risky asset, but also it can act as a safe haven sometimes. There's a pointer here which says that risk off currencies are also known as safe haven currencies. Safe haven because that is where the big players put their money in times of global economic uncertainty. So how do risk on and risk off affect currency pairs? There is kind of a currency correlation bit in here. If we say that risk is on, we mean that these cluster of currency pairs over here are rising, and they are rising because Euro, GBP, AUD, and NZD in these pairings are risky currencies and they are stronger than the USD. Conversely, USD CAD would be falling because CAD would be stronger than the first currency in this currency pair, which is the USD. We also say that risk is off when USD JPY and USD CHF are falling. Risk is off when they are falling because JPY and CHF are safe havens and they will be stronger than the USD. The opposite of the first situation is also true. Conversely, we can say that risk is off when Euro USD, GBP USD, AUD USD, and NZD USD are falling or USD CAD is rising. Risk is off over here because USD will be then acting as a safe haven and it will be stronger than these cluster of currencies over here. Also, USD will be stronger than the CAD over here, and that will be a reason for the USD CAD to rise. Risk is also on when USD JPY and USD CHF are on the rise. This is because the JPY and the CHF over here, which are proper safe havens, would be weaker against the USD. So we can see that USD is a safe haven, but then when it is paired with the JPY and the CHF, we have safe haven pairings. That is why in the middle of the video, I said that the USD as a safe haven is a very dicey situation. So basically, when we say that risk is on and risk is off, this is what we mean by risk on, risk off moods. I really hope that the concept of sentimental analysis with risk on and risk off moods has been simplified for you. If you like this video, don't forget to click on the like button, which will help with the YouTube algorithm. Also, subscribe to my channel for more content on Forex trading like this one. Bulls make money, bears make money, and pigs get slaughtered.